You're listening to the Brinkman Report, bringing you the latest insights into multifamily investments in the Intermountain West. Join Kevin Brinkman, founder and chief executive officer of Brinkman Real Estate, as he talks to industry experts in every facet of the business to go beyond the headlines and dig into the data. Kevin will welcome leaders in capital markets, acquisitions, investment, asset management, and more to discuss real-time market trends, as well as first-hand experiences in the industry, focusing on the unique dynamics of multifamily investments in the Mountain States. Visit BrinkmanReport.com to subscribe and receive monthly episodes straight to your inbox.
Hey everybody, this is Kevin Brinkman, and this is the Brinkman Report, the only show specifically covering multifamily investing in the Intermountain West. Today, I am joined by Brady O'Donnell and Matt Vance with CBRE. They are here to provide their view on the current market conditions and how best to navigate the multifamily real estate investment cycle. Brady O'Donnell provides leadership with CBRE Debt and Structured Finance Services in Colorado, and Matt Vance serves as Vice President and America's Head of Multifamily Research for CBRE. Matt is also a senior economist with CBRE Econometric Advisors, the firm's science and forecasting arm. Thanks for joining me today, guys.
Thanks, Kevin.
Yeah, thanks, Kevin.
All right, Matt, let's kick it off with you. Can you tell me a little bit more about your background, how you ended up in multifamily research, and how you spend time in your role?
Absolutely. I left grad school back in, 2014, 10 years ago, maybe a little longer. And I ended up in private equity in Colorado, not far down the street from Brady. And we did a lot with multifamily because we recognized the sort of longevity and the resilience of the sector. And so I cut my teeth on it there on the deal side, and then found myself coming out of a PhD program in economics with CBRE's Econometric Advisors, as you noted, doing some forecasting and modeling. Since then, I've led a bunch of different types of research, I suppose, both geographically and across sectors for CBRE. And then a few years ago, I really wanted to get back to I think where my heart is, which is the residential sector and specifically multifamily. So that's what I've been doing. We've been kind of growing a research platform for CB that covers both the for sale market and the residential market, but really only insofar as the way today that for sale market is influencing how we view the trajectory of multifamily. So that's sort of what we've been doing, and or what I've been doing.
Awesome. Thank you. Lucky to have you on today. Appreciate it. Brady, will you talk a little bit on your role and how you spend your time?
Sure. So I head up the CBRE Debt and Structured Finance team based here in Denver. We're a national team, focused most of our business in the Intermountain West and Pacific Northwest, although we do business really all over the country. And for the most part, focus solely on multifamily sector, and expands into the build-to-rent sector and all components as it relates to multifamily. So we're strictly the finance arm of the business, and we speak to the capital markets trends and all that go on within CBRE's service offering as it relates to multifamily.
Great. Well, thanks for being here. The game plan is to start high level on the economy. We'll talk interest rates, debt markets, and then really go into specifics on the multifamily market and transactions. So I wanted to start with you, Matt. Are you in the soft landing, hard landing, or no landing camp when you're looking at a high level macro point of view?
I align with CB's house view, which, as it turns out, aligns with really the consensus view of economists, which is that we do feel that it will be a soft landing. We do think, though, that the inflation prints will continue to trend down as we anticipate, as we hope, right, and as the Fed intends, and that we will see even as many as 2 rate cuts this year. We think July is pretty much off the table, but we don't rule out September in our base case. But we're firmly in the soft landing camp, and I think that's true for most today.
Interesting. In the multifamily world, so much is on the 7-year, 10-year treasury. So we spend a lot of time on the Fed funds kind of rate and so forth. What's your view on what the 7-year and 10-year treasury will do over the next 12 to 24 months?
We don't really explicitly or formally forecast the 7, but we do the 10. And so we expect that we'll end this year at around 4.1% in Q4 for an average. We think we'll end next year just under that at 3.8%. And then if we look further out, right, in sort of years 2, 3, 4 of the forecast, we think those long-term rates are going to continue to trend down, but not as low as they were going into the pandemic. It's certainly not as low as they were sort of in the heyday of investment activity in 2021, early 22. So just for our baseline scenario, we expect 3.4%, somewhere in that range in 26, 27, and 28. So, that has knock-on effects and implications for other, things we'll talk about later. So we'll reference back to that. I probably will, but that's kind of our outlook on the interest rates. For the Fed funds, next year we expect to be sort of in the 4.25% to 4.5% range. And then for that to drift lower by quite a bit, maybe just below 3% in 26, 27, 8.
Gotcha. Brady, I know you're talking to your borrowers all the time on interest rates. What are you advising right now? And if you were a borrower, would you fix rate or would you consider floating it, thinking that rates are going to come down?
Well, I think we're definitely offering options on both floating and fixed now, whereas the floating rate options weren't as prevalent in terms of the menu of options we've been presenting over the last 12 months. But now, as we think we've crested and we're going to start to see some recovery on Treasury and SOFR trends coming towards us in terms of increasing transaction volume and all that, we're definitely offering a floating rate option and trying to negotiate floors as low as we can to enable a borrower to take advantage of rates coming in over the next 12 to 36 months.
Gotcha. Would you mind going a little bit more detail on the financing options that are out there? I think if you wouldn't mind specifically talking about the agencies, Freddie and Fannie, because that's a big differentiator multifamily has, that that they're out there, and I think it's 60% of multifamily right now is through the agencies. Is that about right?
Yeah, I mean, historically they've been somewhere between 50 and 60% of total multifamily debt volume, and because many of the alternative lending options, such as banks, have been more or less out of the market, they pick up a larger share of that. So 60%, they're trending towards 60%, potentially higher. In general, our firm has been the largest agency provider for many years, both Fannie and Freddie. And based on reduced transaction volumes, there is plenty of agency money out there that's not getting utilized. Last year, they left, close to $40 billion of allocated funds to Fannie and Freddie unutilized. And this year, because of transaction volumes being much lower, it's something like that's going to happen again. It probably won't be quite as high, but spreads in the multifamily sector for both Fannie and Freddie, kind of out of the box, are in and around 150 basis points. And depending on level of affordability, and they both offer the ability to buy down spreads, you can get spreads down as low as 120. So if you've got treasuries in the mid 4s, you're talking about 570 plus or minus coupon, and cap rates in many markets are in the mid 5s. So you're very close to neutral leverage. And as you hit neutral leverage, you see transaction volume kick up. Because we haven't quite hit neutral leverage, we're within shouting distance of it. You see transaction volume pick up, but not hit probably what we think will happen as we start to see rates come down. Transaction volume should pick up significantly. There's been a lot of deals that just have been on the shelf until people can justify neutral leverage or put off refinances because they believe rates are improving.
Brady, did those spreads come in recent months?
Investor spreads, which is just a component of the overall spread, have come in, and we don't know that there's much room for investor spreads to improve from where they are today, but that's been the component of compression of the overall spread number that's been on the improving side. Treasuries have been so volatile that it's been tough. A lot of transactions get signed up, go under contract or LOI, and then you'll have a 20 basis point movement out on Treasury yields, and a lot of those deals end up falling out. So there's just the volatility has not lent itself well to getting transactions all the way through to completion. And we hope as that settles out and spreads, we believe will stay fairly flat or consistent, we'll get some normality back to the market.
Great. Brady, I know both Freddie and Fannie offer a near stay program. Would you talk a little bit more on that?
Sure. So Fannie Mae and Freddie Mac have offered what we call a near stabilized product offering that allows assets that have been delivered but are not yet fully stabilized to pursue permanent debt through either agency lender. And their program really hits stride at 80 to 85% occupancy, trending upwards towards what is typically 90 to 95% fully stabilized occupancy. So what the agencies do is basically underwrite a 120-day forward-looking window of NOI, and they anticipate the occupancy to increase to a stabilized level somewhere in the mid to low 90s, and then they look forward on burning off concessions, stabilizing expenses, and getting RUBS caught up, and ultimately enable a borrower to exit a construction loan that's probably towards the end of its initial term or even into its option periods, and get on to permanent non-recourse debt on an interest-only basis, which is for the most part desired by most borrowers today. And it's been a great product based on the amount of supply that's come online and the inability of banks to continue to extend not only construction loans, but loans in general. It's been a very popular product, across the country. And, in our market, in Intermountain West and the Pacific Northwest, there's been a decent amount of supply, and it's probably without question, the number one pre-stay product out there. There are some life insurance companies that also offer what they call pre-stabilized products. They do the same thing. They basically look forward to a stabilized NOI, and they give a borrower the benefit of the doubt of getting that based on the trend line over a period of 3 or 4 months, and bring them up to speed on the ability to finance today versus later in the year.
Gotcha.
Matt, are you seeing anything, as it relates to supply? We know that supply is up for the time being. That's probably not long lived, but I'll let you kind of take the supply silo.
Yeah, absolutely. I think this new product offering is coming at just the perfect time, right? And it's not by accident, because there is a lot of supply nationally. I think it's 1973 is the year since we've last delivered this much product in this period of time. So lots and lots of projects coming out of the ground. We do see a tremendous amount of renter demand. In fact, we've seen developers do an incredible job putting these new units where demand is the strongest and best equipped to absorb them. Some of it, when you look at a local level, is at the expense of some of the lower quality product and some cannibalization. But a lot of it is coming from population growth, household formation, and job growth that continues and drives new demand for rentals. And with a completely unaffordable for sale market, we're seeing an even greater share of that household formation coming into multifamily rentals. Now, the supply picture and those markets best equipped for absorbing them is largely across the Sun Belt. So we're seeing some very large absorption numbers in Texas, for example. But the Mountain West is behaving very similarly with the jobs being added and the supply response that we've seen to the rent growth, of a couple of years ago. So, looking at Boise, for example, right, adding almost 9% to their inventory over the past year. Salt Lake City adding almost 8% to its inventory over the past year, with a great deal more supply still in the pipeline. So it's, I think it is a challenge, but it's a near-term challenge. And that's what it is, because Brady, to your point, it is going to be short-lived. I get asked a lot, are we gonna find ourselves in 2026 with zero new supply? My answer is always no. That is not our outlook. Brady, you already touched on it. These projects are taking longer and longer to deliver. We think that the sort of cliff in deliveries is going to be smoother than I think a lot of people want to believe it will be, because of those construction delays. And because things are continuing to be started. In fact, we have people still putting holes in the ground in Austin, Texas, which has as a percentage of its inventory, the most under construction anywhere in the country. So we do have new projects started. But that all said, the current pipeline, I don't know what numbers the listeners are looking at, right? There's many data providers that give a perspective on supply pipelines. It is an upper bound on what might deliver.
Brady, would you mind talking a little bit on the challenges you're seeing with your clients trying to get projects out of the ground?
Sure. It used to be that we'd underwrite deals on about a 5% return on cost, and that became kind of the norm. And based on the cost to construct, the basis in land, and the new interest rate environment, a 5% return on cost doesn't really work anymore. And so now you're talking about pushing return on cost up north of 6%, as close to 7% as you can get it. And a number of deals are being shelved, whether they be still just raw land that's through entitlements, or deals that are even, clearing land, getting ready to go vertical. So many deals are being shelved for a variety of reasons. One is the availability of construction financing. The other is the fact that there's a lot of people with a land basis that they deem now is maybe too high, and they need rent growth and fundamentals to come back before they could justify going vertical. Lastly, the cost of construction, although there's a few commodity items that have come down, most of those costs to construct today have not come down or are staying relatively flat. So it leads to a different opportunity in the marketplace, which I think is the basis play. And I know, Kevin, you and I have talked about basis. Basis is so important. You take basis and oncoming supply into consideration anytime you're buying an asset in any market. And I believe there's some fantastic basis plays out there based on the cost to construct new still being as high as it is, and the availability of assets in certain cases being $50,000 to $80,000 lower than it would cost to construct new across the street, which is a fantastic opportunity for many investors today.
Yeah, no question. I mean, that's what we're looking at right now. If we can find newer product for close to 200,000 a unit, and we know new construction is going to be over 300, you're going to be, happy with that investment if you're able to hold it, longer term. But also others look at cap rates and IRR. So Matt, would you talk a little bit on what the CB view on cap rates is?
Certainly. I think the short answer is we expect them to come down over the next several years. But the reasons for that, I think we've mostly already covered, right? We expect longer term interest rates to bring down the cost of the borrowing costs, right? And the coupons on loans. We expect rent growth has bottomed and is heading in the right direction. Nationally, we're still positive. But with this reduced, new supply pipeline, projects entering the pipeline, and the burn off of what is under construction today over the next, call it year or year and a half, we expect rent growth will not only begin accelerating or continue accelerating this year in some markets, but to accelerate really through 2028. So we get asked a lot, are we going to get a big rent pop in 2026 when very little supply is hitting the market? And our perspective is no. We think the delivery timeline for these projects is going to be a little smoother, not quite a cliff, but as Brady said, 50 to 60% less than it was or is today. So with rent growth, lower borrowing costs and interest rates, and a ramp up in investment activity, all of these things are putting downward pressure on cap rates. So our view is that for multifamily specifically, cap rates will be down on average, that's all product types, 50 or so basis points over the next several years.
And then on average, what are you thinking for rent growth over the next 2 to 3 years?
Boy, it's really market and submarket dependent. Yeah. We do, for the most part, believe that rent growth will exceed, its pre-pandemic average by a bit. So we'll be in a period of outperformance from a historical perspective for a few years once we get through this period of heavy supply. And so, we were just looking at at some projects in Seattle, for example, and we're looking at 3.5-4% rent growth, not out of the question, and that's an average. So there's going to be some underperformance. There's going to be some overperformance. So we underwrote a deal earlier this year in Walnut Creek, Oakland, California, a neighborhood there, and the asset even today had lease trade outs north of 9%, when compared to Oakland, a market with some very weak market level stats, it was surprising for us. And so it's going to be asset, sub-market, and market specific, but outperformance above average rent growth once we get through the supply in 2025.
Yeah, and one of the big challenges has been the increases on the OpEx side. I'm sure that everyone's experiencing, specifically property taxes and insurance. What's your view on the future there? Are we going to get any relief over the next couple of years?
That's a crystal ball question, Brady. You want to?
Yeah, no, I think we're seeing a few green shoots. I mean, the tax issue. There's even in Colorado some talk about maybe some curtailment on property taxes. We're yet to clearly understand how we get there, but there is legislation out there trying to bring that back into check to some degree. We're definitely seeing some strategies around how you insure portfolios and ways to do it more efficiently, maybe even self-insuring certain components of the overall coverage relative to hail or other things that have become wildly expensive in certain parts of the country. So just getting creative about how owners insure their portfolios. We believe that there are ways to bring that cost potentially back in instead of continuing to watch it go out. And then, payroll. If we eventually get to a point where our employment story isn't as strong as it has been for the last year or two, I think we'll start to see a little bit of relief on the payroll side and the migration component and in-migration into certain markets that appear to be right side up in terms of all the fundamentals. I think you'll see certain markets that have benefit to payroll, insurance costs, and hopefully property taxes will come either flatten out or potentially, like in Colorado, potentially even come in a bit. And that will make a huge difference in terms of people coming off the shelf, especially the institutional investors who have been kind of watching all this play out. There's no question that it's cost more and more year over year to operate assets, and the cost to construct has continued to go up. You finally see, I think, land values have peaked and probably come down a bit. So all of those things coming together, I think, will be to the benefit of the investor and the developer here in the coming year, 2 or 3.
Well, while you guys have the crystal ball out, I'm concerned that as the year progresses, we're going to get closer to the election and people are just going to kind of go on hold because of the uncertainty and just kind of kick it till after election. And then they're just going to wait until 25. Matt, will you talk a little bit on how you view the implications of the election in November?
Well, I think it is more important what happens with the jobs and inflation numbers that are printed in the months leading up to it and the response from the Fed. Because I think more favorable inflation and jobs numbers giving us more and more confidence that the Fed will move pre-election with a September rate cut will overwhelm the impact of the election. I think that's our house view, certainly my personal view. Brady, I think you also probably have an opinion on this, but if we don't get a rate cut, we don't get favorable inflation and jobs numbers, again, it's going to be hard to pin any outcome of that or any outcome, around the timing of the election to the election, right? Because what that means is we're also going to have to find a way to pin some of that impact to the Fed pausing for longer, right? And more uncertainty or less certainty around the trajectory of the economy. So it's going to be a very complicated next several months. And depending on how the economy unfolds, will make it easier or more difficult to understand how the election impacted the investment markets.
Yeah, I would say the election is more just yet another reason for a lot of this institutional money to sit on the sideline for another, handful of months. But in the end, I do believe it's all about the economy, and both parties, I think, are looking at that as a top priority. Whether the world sees one as versus the other as being more advantageous to getting the economy going in the right direction and curbing inflation, which is what's caused a lot of this challenge on the commercial real estate side of the fence. Yeah. The Fed is really what I'm watching more closely than who's in the White House, and I think that will continue to be the rule of the day, I guess.
Do you see the geopolitical concerns the same way? If you look at Ukraine war, what's going on in Gaza, what's potentially, threat of Taiwan, does the economy and the Fed trump everything, or is that something that you guys are keeping a close eye on?
Well, we've looked at geopolitical events over a many decade history, and they have little effect on the economy. There's really almost no correlation between something happening in the world outside of a global pandemic, of course, but the geopolitical events really don't immediately or directly impact the trajectory of these large economies. So we're not so concerned about that. They don't really play a role in our house view scenarios. So no, we do think that the Fed and the economy is going to rule the day. Yeah.
So with that conversation, with all the moving parts and uncertainty in the market, what do you guys have conviction on? What do you when you take a step back and say, I'm really have conviction on this? What is it?
I would just say I'm convicted on the U.S. economy and the desire and need for new multifamily units across many parts of the country. Not necessarily all, but there are definitely regions within the U.S. that we expect to continue to grow and to continue to prosper from an employment standpoint. So the multifamily sector within the overall commercial real estate industry, in my opinion, is as good a place as you could want to be. And I feel like the next 2 to 4 years for all of us in that industry, we'll be able to find great investment opportunities. We'll find that the overall debt market is coming towards us for the most part, not going against us as it has in the last 2 years. So I feel bullish about it. And the fact that we can kind of see through the near-term supply issue and on into the frontier of opportunity is exciting for all of us here in the Rocky Mountain region.
Yeah, I'll echo what Brady said and add a few, put a finer point on it, because we sentiment is really important when it comes to economic activity and all of that. And consumer sentiment remains high today. Our investor sentiment remains high as well. And so we administer an annual investor intentions survey each year. And for the second year in a row, multifamily remained the number one most preferred asset class among the major food groups for U.S. and global commercial real estate investment. And this year in the U.S., for U.S. investors, it ran away with the number one spot, with industrial still number two, but well below. And they don't just speak with their intentions and their sentiment, right? Multifamily over the past 20 years has evolved into the sector that captures nearly 1/2 of every dollar invested in U.S. commercial real estate. It is a very sought after investment vehicle, right? Especially within commercial real estate. So I, like Brady, have a lot of conviction around the U.S. economy, the things that drive the demand for housing, but also on the supply side, we estimate that the U.S. is short almost 4 million homes today. And so to Brady's point, we're going to need more multifamily development, almost 2 million units over the next 10 years, notwithstanding the supply that's currently underway today. So I think Brady's right. We've got to get through the next year or so of slower times, but that things are coming toward us and not away from us anymore. And that's fundamentals. It's investment activity. It's sentiment. It's economic expansion once we get through what we've talked about, the slow landing, et cetera, next year. So I have a lot of conviction like Brady does, not just around real estate and the economy, but multifamily specifically. And then you look at the regions of the country that are going to remain economic engines, right? And it is many of the markets in the mountain region. It's many of the markets in the Sun Belt, but it's also many of the markets on the coasts. And so, I like all of the markets, and I think there's reason to be optimistic for investment opportunities almost anywhere, but certainly inclusive of the mountain region.
Well, thank you guys. Appreciate your time and your thoughts. It's great to leave it on a little bit of optimism there. So thank you, Brady. Thank you, Matt. We'll have your contact information in the show notes, so all the listeners can reach out to you directly. And thanks for listening. And we look forward to bringing you another show next month. Bye-bye.
Thank you.